financial markets just move randomly, well, think again. What you're really watching is a super organized, high-stakes game of cat and mouse. So today, we're going to put on the smart money glasses and see exactly how this game is played, and more importantly, why they kind of need you to lose so that they can win.
Okay, let's be real for a second, because I bet this has happened to you. It's a feeling almost every trader knows. You set up your trade, you put your stop loss in what feels like a perfectly logical safe spot, and then you just watch as the price comes down, taps your stop perfectly, and then boom, it reverses and goes exactly where you thought it would. It feels personal, doesn't it? Well, it's not personal, but believe me, it is intentional.
And you know, the crazy thing is, the problem starts with the very things we're all taught. We learn about these chart patterns, all these indicators, these key levels, and we believe they're the secret sauce to the market. But what if? What if those tools are actually part of the trap? What if what you've been trained to see is precisely what the big institutions want you to see?
And this right here, this changes everything. When a resale trader looks at a chart, they see a strong support level and think, okay, that's a floor. It's a safe place to buy. But an institutional trader, they see something totally different. They don't see a floor. They see a giant pool of money, a treasure chest. Why? Because they know that just beneath that line, there are thousands and thousands of retail stop-loss orders, all clustered together, just waiting.
And it's not just support and resistance lines. It's all the classic patterns we learn right out of the textbook. Your double tops, your trend lines, your flag patterns, you name it. We're taught to see them as a green light, a signal to jump into a trade. But for the smart money, these patterns mean something completely different.
So here's the big illusion breaker. These patterns aren't predictive signals at all. They are engineered zones. They're deliberately created by institutions to get retail traders to place their orders in very predictable places. All this does is build up those pools of stop losses, which then becomes the actual fuel for the next big move.
And that right there, that brings us to the absolute core idea of how institutions trade, the hunt for liquidity. This is the real game. Smart money isn't staring at a head and shoulders pattern. They're playing on a much more fundamental level.
So what is liquidity really? Well, in this world, it's just a huge cluster of orders sitting at a specific price. See, when a huge bank needs to buy or sell $1 billion worth of something, they can't just click buy. An order that big would move the market against them. They need a massive number of people on the other side of their trade to fill their position. And where do they find that? In our stop losses. We are the fuel.
This is probably the single most important sentence you'll ever hear when it comes to trading. It's a hard truth, but it's the truth. If you're drawing lines on your chart, but you can't point to where those big pools of orders are probably sitting, then the market isn't looking for liquidity, it's looking for you.
So you've got two kinds of liquidity, right? Above a key resistance level, you have what's called buy-side liquidity. Those are all the stop losses from people who sold short. Then, below a key support level, you've got sell-side liquidity, all the stops from people who bought. To smart money, both of these are giant targets. If they need to sell $1 billion position, where better to go than a place where thousands of traders are forced to buy? And really, this all boils down to an incredibly simple business model. Just like any other business, institutions want to buy low and sell high. They buy at a discount, they sell at a premium. They are not chasing rallies or panic selling into a crash. Nope. Instead, they engineer these liquidity grabs specifically to get the best possible prices for their huge orders.
So if their goal is to buy cheap and sell expensive, how do they actually create those opportunities? Well, it's not by luck. It's a deliberate, systematic, three-phase process that you'll see play out again and again and again. It's often called the AMD cycle: accumulate, manipulate, and then distribute.
Okay, so the cycle kicks off with accumulation. Price just kind of chops around sideways, in a range. This encourages traders to buy at the bottom and sell at the top, which neatly builds up liquidity on both sides. Then comes the really sneaky part: manipulation. This is a sharp, aggressive move in the opposite direction of where they really want to go. This liquidity grab is designed to trigger all those stops. And finally, now that they've filled their huge positions at a fantastic price, they begin the distribution phase. And that's the real, sustained move, where they unload their positions onto all the breakout traders who are now chasing the price late to the party.
Now, a key tactic they use in that manipulation phase is called inducement. Think of it like bait on a hook. It's a small, tempting little price move that looks like, hey, the trend is starting. It's designed to persuade you, to induce you to get into a trade.
This creates a brand new pool of fresh liquidity, your stop loss, that they can then go and grab right before the real move kicks off. It's a trap, plain and simple.
So if the big institutions aren't even looking at the same chart patterns we are, what are they looking for? Well, the answer is imbalances. They are literally hunting for spots of inefficiency in how the price was delivered.
And that brings us to something called a fair value gap, or FVG. Think of it this way. When price shoots up or down really fast, it's kind of inefficient. It leaves behind a literal gap on the chart, an imbalance between buyers and sellers. And for institutions, these gaps act like magnets. Price will very often come back to fill these gaps to restore balance before continuing on its way.
Okay, so we've got all this new information. The big question is, what do we do with it? How do we shift our entire perspective? How do we stop being the hunted and actually start following the hunters? Well, it's all about learning to spot the institutional footprints they leave behind. This is the mental flip we have to make. We have to stop thinking like the mouse, constantly worried about where the next little piece of cheese might be. Instead, we need to start thinking like a detective, looking for the footprints of the cat. Because where the cat goes, that's where the market is going to follow. And one of the clearest footprints you can find is something called an order block. It's super simple. It's just the last down candle right before a strong move up or the last up candle right before a big drop. This is so important because that one candle often marks the exact spot where institutions placed a huge block of orders to kickstart the whole move. Price loves to come back and retest this area before continuing the trend.
So let's put it all together. The new playbook looks something like this. First, stop drawing trend lines and start looking for where the big pools of liquidity are. Second, and this is crucial, be patient. Wait for that manipulation, that liquidity grab, to actually happen. Let someone else be the bait. Third, after the grab, look for price to pull back into a high probability zone, like a fair value gap or an order block. And finally, you think about entering your trade after the trap has already been sprung, after all that retail liquidity has been swept away.
So in the end, it really all comes down to this one question you have to ask yourself. In this market, are you the hunter or are you the hunted? You can either know where the liquidity is or you can be the liquidity. Once you understand how smart money thinks, I promise you, you will never look at a chart the same way again.